Two stores, same street. On the left, a giant supermarket. Every time that scanner beeps, the books update themselves. Inventory down. Cost of goods sold up instantly. That's Perpetual. We lived inside that store for a whole video. Now look right, a tiny corner store. No scanner, no beep. All year the owner writes down just the sale, nothing about cost. Then one night in December, she locks the door, grabs a clipboard, and counts every item on every shelf. And from that single count, she discovers her cost of goods sold. Here's the promise I made you back in the Perpetual video. Remember the cost of goods sold formula. Beginning inventory plus purchases minus ending inventory. I told you, in the Perpetual world it's just a check. But one day it would get its own system, its own machine. Tonight, I keep that promise. Tonight, the formula is the machine. But before we dive in, let me give you the single best study habit I know. The one that changed everything for me. See that cheat card near the end of this video? Print it out and keep it right beside you tonight. Every time something clicks, add it to the card in your own words. Little by little, that one page becomes your whole chapter. Everything you need, in your own handwriting. So if you ever feel lost, don't stress. Just look down and fill in your card. This is exactly how I got through the hardest exam of my life. I took 10 thick textbooks and boiled them down to 20 pages. And if you've ever faced the kind of exam that turns grown adults into note-condensing machines, you know exactly the one. I mean, one thing before we start, and I mean this. This is part 2. If you have not watched part 1, the Perpetual System, the full merchandising lecture, go and watch it first. The link is on the screen and in the description. Tonight I rerun that exact same story on different books, so if part 1 is not in your head, half of what makes tonight click will slide right past you. Watch it first. I will wait. Alright, welcome to Chapter 5, Part 2, the Periodic Inventory System. Let's begin. Quick rewind. Both stores fresh in your head. Perpetual. Every beat moved 4 accounts at once. Cash or a receivable in. Inventory down. Sales up. Cost of goods sold up. A running record. The books knew the shelves cost every single second. Periodic is the opposite personality. Periodic as in once per period. During the year, no running inventory record at all. Nobody logs the cost when goods sell. The inventory number just sits there, frozen. And cost of goods sold, the company doesn't know it until the end of the period. Same street, same goods, 2 totally different sets of books. So here's tonight's plan. We rerun the exact Maple Street story from part 1, same tablets, same numbers, but on periodic books. You know one road. Tonight you walk the other. They end on the same 2 numbers. Let's make it baby simple. Under periodic, you do not track cost as goods come and go. You find out once at period end by physically counting. Honestly, it's like my gym attendance. No continuous record, just one painful count at the end. Here's the count. For every product, units on the shelf times unit cost equals total cost, then sum every product. That's your ending inventory. And it's not optional. US rules require a physical count at year end. Then the magic, cost of goods sold is deduced, not recorded sale by sale, deduced from the formula. See that little card top right? Beginning inventory plus cost of goods purchased minus ending inventory equals cost of goods sold. Screenshot it. We build it in full detail later, and it's the heart of the whole night. For now, the baby version. All year, your books know what you sold things for, not what they cost you. Count first, then the formula tells you. So where does all that cost hide during the year? 4 new accounts. Let's meet them. In Perpetual, every cost drove into one account, inventory, one garage. Periodic says, nope, during the year, inventory is asleep, frozen. So where do the costs park? 4 brand new accounts, and these are the 4 you'll journalize with for every purchase, in the exact order they happen. 1. Purchases, the cost of merchandise bought for resale, temporary debit balance. 2. Freight in, the truck that brought the goods to us, also debit, an adjunct to purchases because shipping makes the goods cost more. 3. Purchase returns and allowances, goods sent back or price cuts, a contra account, credit balance, it reduces what we bought. 4. Purchase discounts, the reward for paying early. Also contra, credit balance, it shrinks the cost too. Now watch them assemble. Purchases minus returns minus discounts. That's net purchases, then add freight in, and all 4 empty into one number, cost of goods purchased. That's the single number these 4 accounts exist to build, and we'll run it through the full machine with a solved example later tonight. 4 accounts, 1 job, time to put them to work, meet the store. Meet Maple Street Electronics, the exact retailer from Part 1. Same story, same numbers. One difference, tonight, periodic books. And it just opened, empty shelves, so beginning inventory is 0. The buy side is 4 entries, and I am going to number them out loud so you can rehearse them. 2 on this board, 2 on the next. Entry 1. Buy 50 tablets on account, $10,000. Terms 2, 10, net 30. FOB shipping point. Perpetual debited inventory. Tonight, debit purchases 10,000. Credit accounts payable 10,000. Only the debit changed. Purchases not inventory. Entry 2. The freight. FOB shipping point. We own the ride. We pay 300. Perpetual buried it in inventory. Periodic gives it its own account. Debit freight in 300. Credit cash 300. Look right. Both times. Perpetual's answer is always inventory. And one warning to circle in red. Freight is never subject to the purchase discount. That 2% deal lives on the merchandise, not the truck bill. Remember that. Entry 4 is about to make you use it. Quick gut check before we roll on. Pause the video. Periodic books. Buy 7,000 of merchandise on account and pay 400 of freight in cash. Write both entries and bonus. Which one account would a perpetual bookkeeper have debited both times? Ready? Entry 1. Debit purchases 7,000. Credit accounts payable 7,000. Entry 2. Debit freight in 400. Credit cash 400. And the bonus? Perpetual sends both to inventory. If you reached for inventory and caught yourself, that reflex is forming. Nice. Now, the give-backs. 2 more buy-side moves, entries 3 and 4, the back half of that run of 4, and I'm going to hand you a method that saves you on every exam. Entry 3, 5 cracked tablets, $1,000 going back. Perpetual credited inventory. Periodic parks it in its own account. Debit accounts, payable $1,000. Credit purchase returns and allowances $1,000. A contra account, so management can see what came back. Now freeze, because here's the method. The moment you post that return, draw the accounts payable T account. $10,000 on the credit side, $1,000 on the debit side, balance. $9,000. That $9,000 is what you actually owe. Now the discount. The 2% applies to the balance. $9,000, not the $10,000 invoice. 2% of $9,000 is $180. Entry 4. We pay on day 8, inside the window. Debit accounts, payable $9,000, credit purchase discounts $180, and cash is the plug. $9,000 minus $180, $8,820. Always work it that way. Read the balance off the T account, apply the rate, let cash plug the gap. Do that, and you will never miscompute a discount again. 4 entries, buy side, done. Let's assemble. Buying season's over, 4 parking spots, full, assemble them. Start with purchases 10,000, subtract the 2 contra accounts, returns 1,000, discounts 180, and you get net purchases, 8,820. That's what the goods truly cost after the give-backs. Now add the truck, freight in, 300, and land on cost of goods purchased, 9,120. Now freeze, 9,120. Seen it before? In the perpetual video, after the same purchase, freight, return, and discount, the inventory account carried exactly 9,120. Same reality, same cost. Perpetual stored it live. Periodic assembled it at the end. Hold that number, 9,120. We're about to make the sale, and something goes very quiet. Here's the moment this whole video exists for. And the sell side is a run of 4 too. Entries 1 and 2 on this board, 3 and 4 on the next. Maple Street sells tablets, 9,000 on account. That cost us 5,400. In part 1, this was the 2-entry rule. Revenue first, then a second entry moving the cost out of inventory into cost of goods sold. Tonight, entry 1, debit accounts, receivable 9,000, credit sales revenue 9,000. And the cost entry, listen carefully, there is no cost entry, no cost of goods sold, no inventory, nothing. The beep goes silent. Periodic books simply do not know the cost on the day of the sale. Now watch this one, because it does the opposite. Entry 2. We pay the freight out, $420 for our own truck to carry those tablets to the customer. Debit freight out, $420, credit cash, $420. And look at the 2 columns. They agree. Freight in split the system's its own account here, straight into inventory in part 1. Freight out is a delivery expense, an operating cost that sits below gross profit, so it is written the same way in both books, and it never touches inventory at all. One word apart, opposite behavior. And that 5,400, it stays invisible until the count. Same quiz as the perpetual video. Same numbers, new books. That's the point. Pause. Periodic system. Sell merchandise for $2,000 cash. The goods cost $1,200. Write everything. Ready? One entry, debit cash $2,000, credit sales revenue $2,000, and the $1,200, bait. In part 1, it triggered entry 2. Tonight, nothing. It hides inside the goods until the count finds what's left. Wrote a cost entry? No shame. You just proved you learned part 1 cold. But circle this. Perpetual, 2 entries. Periodic, 1. Now the sell side givebacks and a T account trick that'll save you on every exam. 2 sell-side moves, entries 3 and 4, and it's the exact same method you just learned on the buy side. Entry 3, 5 tablets come back, $900. Perpetual would also restock the goods. Debit inventory, credit cost of goods sold. Periodic, just the revenue side. Debit sales returns and allowances $900. Credit accounts receivable $900. A contra revenue account, so we can see what came back. Now freeze, same trick as the accounts payable side. The moment you post that return, draw the accounts receivable T account. $9,000 on the debit side from the sale, $900 on the credit side from the return, balance $8,100. That $8,100 is what the customer still owes. Now they pay, inside the window. The 2% applies to the balance, $8,100, not the $9,000. 2% of that is $162. So entry 4, debit cash $7,938. Debit sales discounts $162, credit accounts receivable $8,100, and cash is the plug. Here's the beautiful part. That collection entry is identical in both systems. It never touches inventory. Exactly like the freight out you wrote as entry 2. Read the balance off the T account, apply the rate, let cash plug the gap. Buy side or sell side, same move. 4 entries, sell side, done. Now everything just sits there until we count it, and that day has come. December 31st. Store closes early. Lights stay on. Everybody grabs a clipboard. This is the physical count, and under periodic, it's not a double check. It is the bookkeeping. Every product, units times unit cost summed, required by US rules at year end. Maple Street counts the tablet still on the shelf, multiplies by cost, adds it up, and the clipboard says 4,260. That's ending inventory. Not a guess, not a formula, boxes touched and counted. And notice why it is that much. The tablet the customer sent back is physically sitting right there on the shelf. Periodic never saw that return in a cost account, but the count sees it because the goods are there. That is the entire argument for counting. Hold it tight, 4,260. Now, the moment I promised you all night. Stop. This slide right here is the single most important slide in the entire chapter. Master nothing else tonight, master this one. Screenshot it. Write it out by hand until you can draw it from memory. Keep it at the very top of your mind, because every inventory problem you will ever face flows through this one framework. And let me be honest about why I care so much. This exact framework is how I passed the hardest exams in accounting when I was a student. And years later, it carried me through my professional certifications too. Same 2 cards, same logic. It never changed on me. So let's build it together and you'll carry it for the rest of your career. Left card, build the missing piece. Cost of goods purchased. Start with purchases, $10,000. Subtract the 2 contras. Purchase returns and allowances $1,000, purchase discounts $180. And that gives you net purchases, $8,820. Then add the truck. Freight in, $300, and you land on cost of goods purchased, $9,120. Now watch the arrow. That 9,120 plugs straight into the formula on the right. Beginning inventory, 0. Plus cost of goods purchased, 9,120. Goods available for sale, 9,120. Minus ending inventory from the count, 4,260. And what's left is what left the building. Cost of goods sold, 4,860. That's the whole machine. Build Kagi on the left. Feed the cost of goods sold formula on the right. Learn to draw these 2 cards cold, and there is no inventory question. From a first course all the way up to the professional exams. That can beat you. This is the one. Own it. And now watch both systems collide. Both roads side by side. This is the picture I want living in your head. The perpetual road. All year, beep after beep, cost moved out of inventory the instant each sale happened. And by December, cost of goods sold had grown sale by sale to $5,400. Then the customer's return handed $540 of cost straight back, leaving cost of goods sold at $4,860, with inventory sitting at $4,260. The periodic road, silence all year, 4 spots filling, 1 count, 1 formula, cost of goods sold $4,860, ending inventory $4,260, identical identical to the dollar, and on the sale itself. Gross profit, 3,640% on both roads. Put it in percentage terms. Sales are always 100%. Cost of goods sold eats 60% of every sales dollar, and that leaves a 40% gross margin. And look closely. That's simply sales minus cost of goods sold, the partial income statement we built step by step, in full detail, back in Chapter 5, Part 1. If that feels rusty at all, pause and go re-watch it. The link is right there on the screen. This is the exact number every merchandiser lives and dies by. The system changes when and how you learn the number, never the truth itself. But one honest warning before you fall for the simple road: shrinkage. Perpetual catches it. Ledger says 70,000, count says 65, 5,000 stolen or broken, visible. Periodic cannot see it. Whatever's missing just isn't on the shelf at count time. So the formula quietly shovels it into cost of goods sold. Theft, breakage, mistakes, all hidden inside one number. Hold that thought. It decides who uses which system. But first, one last drill, the whole machine, end to end. Final quiz, the full machine, end to end. Pause the video and actually write it. Periodic books, beginning inventory, 11,100. Purchases, 41,000. Purchase returns and allowances, 2,200. Purchase discounts, 1,100. Freight in, 1,700. And the December count says 12,200. Find four things: net purchases, cost of goods purchased, cost of goods available for sale, and cost of goods sold. Go! Ready? Net purchases, 41,000 minus 2,200 minus 1,100, 37,700. Cost of goods purchased, add the freight, 1,700, 39,400. Goods available for sale, beginning 11,100 plus, that 39,400, 50,500. And cost of goods sold, 50,500, minus the count of 12,200, 38,300. 4 steps, 1 machine. If you landed all 4, you can run periodic on any exam they put in front of you. Now, the one entry set Part 1 taught you that does not transfer. Here's the trap that catches students who did watch Part 1. You already know how to close a merchandiser's books. You did it at the end of Part 1. Under periodic, those entries change shape. The one place tonight where Part 1 can hurt you. Watch. Entry 1. Record what the count found and close every account carrying a credit balance. Debit merchandise inventory for the ending count, 4,260. Debit sales revenue, 9,000. Debit purchase returns and allowances, 1,000. Debit purchase discounts, 180. Credit income summary, 14,440. Entry 2. Close out the beginning inventory and every merchandising account carrying a debit balance. The operating expenses close alongside them. Debit income summary, 11,362. Credit merchandise inventory for the beginning balance, which is 0 tonight because Maple Street opened this year with empty shelves. Credit sales returns and allowances, 900. Credit sales discounts, 162. Credit purchases, 10,000. Credit freight in, 300. Now look at what income summary is holding. 14,440 minus 11,362, 3,078. And that is exactly net sales of 7,938 minus cost of goods sold of 4,860. Read that again. The closing entries just computed cost of goods sold, and nobody ever wrote a cost of goods sold entry all year. That is periodic's whole personality on one board. And the 4 accounts close in the 2 directions you would expect. Purchases and freight in are debits, so they close with a credit. Returns and discounts are credits, so they close with a debit. One last thing, and it matters next year, that 4,260 sitting in merchandise inventory tonight becomes next year's beginning inventory, the one that gets closed out in entry 2. Tonight, it was 0. Next year, it will not be. Always see the bigger picture. Here's the 9-step accounting cycle you built across chapters 1 to 4. Analyze, journalize, post, trial balance, adjust, adjusted trial balance, statements, close, post-closing. Every step already yours. Chapter 5 didn't add a step, it added players. And notice where periodic does its work. During the year, steps 1 to 3, it records less than perpetual, 1 entry per sale, not 2. But the count and the formula, that's end of period work. Living down in steps 5 through 9. Perpetual spreads the effort across the whole year. Periodic piles it up at the finish line. Same cycle, same map. Just a different place where you sweat. So which system should a store actually use? Line them up. During the year, perpetual, continuous, unit by unit, periodic, nothing, cost of goods sold, perpetual at every sale, periodic, deduced once. Buying, perpetual debits, inventory, periodic debits, purchases and friends. Selling, perpetual, 2 entries, periodic, 1. The count, perpetual, a check that exposes shrinkage. Periodic, it creates the numbers, and shrinkage hides inside cost of goods sold, which means under periodic, a stolen tablet and a sold tablet look exactly the same. Thieves love periodic accountants, less so. So who uses what? Perpetual gives control, but it needs scanners, software, discipline. That used to be expensive, which is why periodic once ruled the world. Then barcodes and cheap computers showed up, and today almost every serious retailer, the supermarket, Best Buy, Amazon, runs perpetual. Periodic survives in small shops, low-cost, high-volume goods, and of course, accounting exams. Professors adore it. Baby version, big store, big system, perpetual, corner store, clipboard, periodic. Both legal, both correct. Choose control versus cost. Let me hand you the whole thing on one card. Stamp it into memory. You now own the periodic idea. No running record. Count at period end. Units times unit cost. The 4 temporary accounts: purchases, freight in, purchase returns and allowances, purchase discounts, buying, debit purchases, never inventory. The 1 entry sale, revenue only. The beep goes silent, no cost until the count. The assembly line, net purchases, then cost of goods purchased. Then the formula deduces cost of goods sold. And the proof accounting is honest. 4,860 of cost of goods sold on both roads. They only disagree on when you find out. And the trade-off that decides it all: perpetual buys control, periodic buys simplicity, and shrinkage hides in only one of them. Chapter 5. Both parts complete. But before you go, there's one thing I've been quietly assuming all night. Screenshot this. The whole chapter on one white card. Left column, buying. The 4 entries in order: buy, freight in, return, pay in window, periodic on top, perpetual below. See the pattern? Perpetual's answer is always inventory. Periodic always has a special parking spot. Middle column, selling. 4 entries again. Same order you learned them. 1, the sale, periodic, 1 entry. Perpetual adds the cost entry. 2, the freight out, 420. And that one is identical in both books, because delivering goods is an operating expense, never inventory. 3, a sales return. Same deal as the sale. 4, the collection, identical too. Right column, the machine, 2 little cards, linked. Build cost of goods purchased in the top card. Purchases plus freight in, minus returns minus discounts, 9,120. Then that number flows straight down the arrow into the bottom card, the cost of goods sold formula. Beginning plus cost of goods purchased minus ending inventory from the count equals cost of goods sold. Pause, screenshot, camera roll. The full PDF's free on the site. Let's lock in what you own. Both roads led to the same cliff. Perpetual or periodic, I let you assume one thing all night: that we always know the unit cost of what's on the shelf. But you bought tablets in January at $200, in June at $220, and in November at $240. Your accountant finds one in December and asks a simple question: which cost is this one? Your answer changes ending inventory, cost of goods sold, gross profit, and taxes. And the law lets you choose. Which cost leaves the bucket first? That is FIFO versus average cost, the great costing showdown. And that is Chapter 6. After tonight, you have both systems ready for it. Before you go, everything is free on the site. Periodic system exercises with full solutions, plus the chapter notes, all at appliedanalyst.com. If a slide lost you, tell me exactly where in the comments. I read and answer every single one, and your question helps hundreds of students stuck at the same spot. And one quick favor: if this video helped you, tap the like button. It genuinely helps the channel reach more students who need it. And subscribe, because Chapter 6 is coming and you will not want to miss it. I'll see you in the next class.